All right, so thanks for joining us today. I'm Matt Fox, and I'm CEO of SpotGamma. Today's discussion is led by our founder, Brent Kochuba, as we show you that while the VIX is highly followed by Wall Street and recognized as the fear gauge, there's often much more under the surface. All right. First, before we dive in, if you're new to SpotGamma, Brent founded SpotGamma in 2020 to unveil how the options market drives prices across stocks, futures, and even the largest US indices. Over the past 5 years, we provide our insights to international publications such as the Wall Street Journal, Bloomberg, and Reuters, contributed to key academic white papers at Columbia University, advised global governmental agencies around the risks associated with options trading, and most importantly, delivered knowledge proprietary content to our trading community. And now let's turn our attention to the VIX and volatility. My last slide. All right, so in today's discussion, Brent will break down how the VIX works and show an example where the VIX acts in a way you may find surprising. At SpotGamma, we believe that by tracking volatility, you can better understand both the VIX and volatility moves as they happen. So let's get into the core content. Brent?
Thanks, Matt. Appreciate it. Hello, everybody. Good to see so many familiar faces and some new ones as well. And so as Matt discussed, we are going to dive into the topic of VIX. Now, I should state before get into this, I look at the VIX every single day, and we think it's a great gauge of general gauge of volatility. But there's a couple of times where its signal can be a little bit misleading, and we want to dig into what those circumstances look like and how you can avoid the trap, so to speak, that sometimes can be shown by the VIX itself. So as we all know, the VIX is considered the fear gauge. If you look at it certainly on a CNBC or something like that, in general, you will find that they will say the fear gauge spikes to new highs, because generally what happens, obviously, as we all well know on this call, when the market goes down, the VIX tends to go up, and then vice versa. So you can see here, obviously, the COVID crash, which I think was the all-time high in the VIX. It really went bananas. If you see this on a candle chart, I think it actually got quite a bit higher than that. And then obviously when the market rallies, the VIX tends to go down. Now the recent markets are breaking that paradigm just a little bit. You can see here the VIX is actually going up. When the market's going up, it's the vol up, stock up paradigm that we've been dealing with recently. But generally the VIX is considered to be this fear gauge, because when the market goes down, volatility tends to increase. And then also there's the demand from people buying puts to hedge their portfolio, and that increases implied volatility, which increases the VIX. These are topics that we are going to dive into. Now, the correlation between the S&P 500 and the VIX is actually pretty easy to see. What you can see here along the x-axis is the one-day percent change in the S&P 500 versus the one-day point change in the VIX. And you can see there's a clear correlation there, where generally when the market goes down, the VIX tends to go up. I highlighted 2022, which was a pretty tumultuous year in the US market. And so you can see that is what is shown there in red. And, there's a pretty much exhibited behavior like we've seen over the last several years. So what specifically is the VIX? How is it calculated? You see little Twitter threads and things like that floating around about this. We want to dig into this a little bit more. The VIX is based off of 30-day S&P 500 index options. So SPX index options are what goes into the VIX itself. Specifically, at least 23 days, but no more than 37 days to expiration. So we call that roughly a 30 days to expiration window. And any option, any S&P option that has at least a nickel bid, calls and puts, goes into that calculation as well. And then there's a little bit of a weighting mechanism. And the weighting mechanism, the key thing to take away here on this is that they provide a weighted approach into calculating the VIX so that they can create this indexified measure of volatility. I'm going to use this word indexified. I use it quite often in our SpotGamma Q&As, because the VIX is obviously calculated as a single number that we look at every single day, and it's meant to sort of portray what volatility, forward volatility is, or future volatility is in the S&P 500. And so in order to sort of calculate a weighting that works on, so to speak, day to day, obviously you need to create a weighting mechanism so you kind of smooth out some of the bumps, and the numbers work again kind of day to day. And so the takeaway here from everybody is simply that 30 days to expiration, and basically all options across the board that have at least a nickel bid. So it's calls and puts go into this calculation. Now, if you wanted to make a base assumption of where the VIX should be or what fair value is in the VIX, generally speaking, you can look at 1 month realized volatility. So just as I said that the VIX is using 30-day options, that's kind of the biggest weighting. Well, if you track, in this case, 1 month realized volatility in the S&P 500, you can see that these two line up pretty closely. Now, the VIX generally trades at a little bit of a premium, meaning you can see the red line, which is the VIX, trades over 1 month realized volatility. And that makes sense because you should say, well, what is my expectation for volatility in the future? Well, tell me where volatility has been, and I'm going to use that as my baseline. And then you got to add a little premium on there. And that premium generally is because of the uncertainty of what's to take place in the future, as well as demand for hedging options, right? There's people that want to buy options, buy puts, et cetera. And that increases a little bit of extra premium, so to speak, in this spread between the VIX and 1 month realized volatility. The other interesting thing to note here is that there's a lag effect, as you know, it takes a while for volatility to mean revert, and depending on what time frame you're looking at, that is true. In other words, volatility can mean revert very quickly in some frames, but then it could take a while to fully revert over longer time frames. So, for example, you know, after the March COVID crash, the VIX spiked to 80 or 100 up in that neighborhood, and it came down very quickly, right? But it never returned to pre-2020 levels up until really the last couple of months. And so that's that multi-time frame sort of mean reversion that we're talking about. The other thing to note about the VIX is that it will rise with realized volatility, but it can mean revert a lot faster. And that's because VIX is a forward-looking volatility measurement. So, for example, in the COVID crash, the Fed came out, we had the big March options expiration, and the Fed also came out and offered, major market support. And so traders said, okay, we think the lows are in and volatility is likely to decrease. So you can sell volatility. The VIX can get pressured lower, but realized volatility takes a while to come back in because it's just a standardized rolling window. And so you need these big violent moves to roll out of that time frame for that realized volatility to come down. So again, if you are looking at this and saying, what's my takeaway? If you were just told, hey, what's 1 month realized volatility in the S&P, and you say, hey, Brent, it's a 13 or 14, if you add roughly 3 points to that, you're going to get a pretty good approximation for where the VIX should be when trying to gauge its fair value, so to speak. So let's get into a case study where we're going to dig into some of these circumstances where the VIX can be a little bit misleading in terms of what it is signaling to the markets. Now, those of you who are SpotGamma subscribers may be a little bit familiar with this topic of conversation. And those of you who are new will hopefully find a lot of interesting insights, because when you see that flashing red on the CNBC screens or people panicking on Twitter about the pop in the VIX, that is not always the signal that it appears to be. Okay, so a couple of weeks ago, start of February, we had end of January, start of February, we had the FOMC and we had bad earnings out of AMD, Microsoft, Google. AMD and Microsoft in particular were down 6% each on this particular day. And after the FOMC, the market really kind of reacted rather sharply. This was again, right at the start of the month. And so you can see here the S&P was down about 1.5%, trading from 49.20 down to about 48.50. It was a rare sell-off in a market that has been really pretty strong this year. And accordingly, we saw the VIX really pop pretty strongly. As you can see here, the VIX just really launched higher from about 13, low 13s up to mid to upper 14s. So that's a pretty good, 1.5 point VIX move. And so the question here is, if I was to tell you, hey, stocks are down 1.5%, VIX is up 1.5 points. We generally don't quote the VIX in percentage terms because it's already a percentage. So 1.5 points, but I want to say 10%. But is implied volatility actually increasing? Now, if you watch CNBC, they'd probably be telling you, yes, it moved. If you saw, a lot of the market pundits, they'd be saying, hey, the VIX is spiking. People are scared. Batten down the hatches, everybody. This could finally be it. This could be the top that we've all been waiting for, right? Now, before we discuss why that is misleading in this case and how you can pick this up in the future, I need to explain a little bit about skew. Now, traders look at skew, which is on your screen here, as a way to determine the demand and expectations, so options demand and the expectations of future market movements. And so what you can do here is you can analyze not only the way that skew is shifting, meaning we can have parallel shifts. So for example, if skew is here and we saw implied vol increase across all strikes, which is across the x-axis, and implied vols on the y-axis, you can see volatility shift and rise. So that's one interesting signal that's embedded in there. And then the second interesting signal that's embedded in there is the actual pivot or the skew itself. So how much is this specific line turning and twisting? And as this line twists and turns, it's giving us a signal as to relative call demand and put demand from traders. Now, way back in 1987, there was the most famous market crash, maybe of all time, I guess, at least certainly in the last 20 years, when the S&P 500 and the Dow and all that dropped, 20, 30%. And I'm a little too young to have traded this myself, but we're told that skew was very normal or roughly flat like this before that 1987 crash. And then after the 1987 crash, the S&P got what's called the permanent put skew. And so what that simply means is, and this is from the SIBO, so you know it's good data here, but when you look at the money strike, which means that it's the strike at where the S&P is trading right now, so that's called the at the money. So when you look at the implied volatility of that strike on this expiration, you compare it to a downside put. There's a couple of different puts you could choose, but let's just say a 1% or 10% or 5% out of the money put. The volatility for that out of the money put is going to be higher than the at the money put. So we call this a put skew. And the S&P 500 almost always has this shape to it. If you look at some stocks like NVIDIA, you can see the opposite, where calls will have a higher implied volatility than out of the money calls, will have a higher implied volatility than the at the money calls. And so the key here is that the reason that we look at skew is, again, gauge how volatility is shifting, both the surface, so to speak, or the skew line itself lifting up and down, which is a more general view of higher or lower volatility, and then how that those implied volatilities are rotating or pivoting. Both of those are critical to analyzing volatility. And so again, we're going to dig in a little bit more a couple of these skew charts. We just want to make sure we set the expectations here so everyone's kind of on the same page as to what's happening. Now, if these lines shift higher, or we get a pivot or twist like we see here, the implication here is that there's higher demand for put options and higher expectations of volatility in the forward. So in the future. So if the curve suddenly was to shift up like this, for example, we would say, okay, people are expecting higher levels of volatility now. Put demand is increasing, and that's a key signal. If we see skew flatten out, then we say, look, people are less concerned about future volatility because that skew is flattening out. Demand for puts is declining, and so that skew pivots back a little bit. Now, in the case of the VIX, if this is a specific expiration, say 30 days expiration, all of the data points here that comprise this skew curve here, all of those individual strike implied volatilities are going to go into the VIX calculation. And so as these skews are shifting around, in theory, the VIX should move along with it as well. So what we're going to introduce here is this idea of the fixed strike slide. This is an idea that we coined, the fixed strike slide, to connotate this phenomenon that the VIXs will generally always go higher just as a function of the S&P going lower. Okay, so almost anytime you see the market go down, you can assume that the VIX is going to glide up because of this idea of the fixed strike slide. I found this slide or this image surprisingly fast. I was very happy I found it. I do wish he was sliding, maybe the other direction. I could flip the GIF around, but this really connotates what is happening with the VIX as the market is going down. And we'll now explain why. So on your screen here is from our implied volatility dashboard. This is our skew tab. And what you can see here is the implied volatility. This is the actual 1 month skew, 30 days to expiration. The day before, we had that really sharp sell-off that I first discussed in this slide here. So this, we're showing the skew before and after. So you can see that on 130, which is the gray line here, we see that this is where skew is. And then the day after, S&P trades down 1.6% to 48.50. And it looks here like skew is showing a shift higher, right? Implied volatility is higher across the board is what one would say here. And accordingly, the VIX registers a higher level of implied volatility. Now, the trick here and the thing that you need to note is, and hopefully some of you picked up on this, is that this is a view of moneyness. So moneyness is a topic that comes up often. We say oftentimes the ATM, or at the money implied vol, which simply means what is the implied volatility of where the S&P 500 or the stock you're looking at, what is the implied volatility of the level at which the stock is trading at right now? So what moneyness specifically is describing is the relationship between the current price of the underlying stock and the option strike. So 5% out of the money would be, look at where the S&P is trading now. What is the strike that's 5% up? 95%, what is the 5% downside strike trading at, implied vol trading at? And so what this is giving you is a relative view of how implied volatility is trading. Now, the issue with this here is, and again, a lot of these SpotGamma subscribers probably know where I'm going with this, is that the 100% at the money strike on 130 when the market was pre-Fed was up at 49.30. But then what happens after the Fed comes out, the market sells off, we have some bad earnings, then the at the money is 48.50 the next day, right? Because that's where the S&P is trading. And so what that looks like when you measure it on a moneyness perspective is you're taking this implied vol and comparing it to this implied vol. So you're comparing apples to like a pear maybe, right? It's not like an orange. We're in the same realm, but apple to pear, not apple to apple. And so what you see here is a little bit of a ruse in that it looks like implied volatility is increasing across the board. You go, well, it looks like put demand is picking up, but this is a phenomenon of the fixed strike slide. Now, hopefully some of you are also picking up on the fact that this is fixed strike slide here is sort of why the VIX is increasing, even though implied vol itself is not necessarily increasing. So let's compare this to what happens when we looked at volatility on a fixed strike basis. So instead of having a moneyness on the x-axis here, we have the specific strike, and then what's being measured here is the implied volatility change at that specific strike. And so why do we do that? Well, on 130, again, we were at 49.30, so we're generally here where the green arrow is, and then the next day we down 1.6%, which is where the gray arrow is. Now, I told you earlier that the VIX looks at every single options, the 30 days to expiration in and around that area, and anything that has a nickel bid. So let's just say for ease and argument here that means that the universe of options that goes into the VIX is this green box, right? Because this is where the at the money is. And so if you take all the options that have roughly a nickel bid or better and you weight them in the right way, we're including all of the options that are here in the green box. So that covers options that have, roughly, let's say 14% implied vol down to 8% implied vol, right? Well, as soon as the S&P 500 trades down, the at the money is now here, as I've been saying. And so the universe of options that goes into the VIX is now in this gray box. Those options have a naturally higher implied volatility simply as a function of them having the lower strike, right? Remember back to the 1987 conversation where suddenly there's this put skew and downside strikes, i.e. all these puts have a higher implied volatility all the time. So all we're doing with the VIX is we're swapping out the inputs. And on this fixed strike slide, the VIX is going up. So it looks like it gives the impression of, hey, implied vol is increasing, everybody, because these indexified measures are showing higher implied vol. But when you break things down on a fixed strike basis, that may not be what is actually happening. And so the key takeaway here is that, yes, the indexes show higher implied vol because they're getting a higher implied vol input, but on a fixed strike basis, we're not seeing a shift of implied vol higher. In fact, this is what we wrote in our founder's note on 2/1. This is the morning of a fairly big sell-off. When we look at things on a fixed strike vol basis, it suggested that at those lows on the first, when we were writing our note before the market opened, that fixed strike vol was actually lower, even though the market was down. So specifically what we said is that even though there was weakness in equities, when you look at fixed strike vol on a day over day basis, what we're seeing is shades of red in this matrix. So what is this matrix? This is part of our fixed strike vol dashboard, but what you see here is strikes up on the x-axis. You have expiration on the y-axis, and we're showing the change of implied volatility from the 30th, which is the nice safe day, to the 31st, which is where we were having that problem. We're seeing that change in implied volatility, right? And so what you see here is shades of red. That shades of red tells us that implied volatility is lower over this period, even though the market is down. Now, you would expect that if people were scared because the Fed came out and said, hey, rates are going higher in perpetuity, Google earnings was a stinker, AMD reaction was no good, that people go, uh-oh, time for me to buy some puts. And if put demand was high, you would expect to see shades of green in this chart, which tells us that, hey, there's demand to buy puts. But instead, what it looks like happened in this case was that implied volatility and fixed strike basis was going down. So this is contradicting what we're seeing in the indexified measures of volatility like the VIX, right? Because the VIX is benefiting from that fixed strike slide as opposed to an actual change in fixed strike volatility itself. And again, I know this term fixed strike vol is a new one, but all that's doing is measuring the change in implied vol at a specific strike. So the shades of red again for all these expirations telling us vol went down despite the market going lower. And so for us, well, the key takeaway was there's a lack of bid of volatility. People are not buying puts. They're not looking to get long VIX futures. They're not doing all the things that suggest they have a bearish outlook. In fact, they're doing the opposite. Vol seems to be coming down, which would suggest that people are selling puts and selling volatility into weaker markets. And so what was the result of that? Well, the next day, the market ripped 2.5%. And the key insight here was that if you paid attention to the VIX, you're probably getting nervous. You're battening down the hatches a little bit. You're concerned because it looks like vol is going up, where instead what actually happened is that vol really took it on the chin, so to speak, and the market moved materially higher. Now, what would it look like if there was actual fear in the market? Well, we're going to show you two slides on that. Number one is you would see an increase in fixed strike vol. So what I did here is I drew what skew would look like. I'm laughing at my third grade art here. But this is what skew would look like actually if there was fear. So let's say that whatever Powell said on that day really did scare people and there was credit risk in the market or whatever else it may be. You can see here that if implied volatility did this, right, and we shifted from where the green and red lines, green and gray lines are up to the red, then fixed strike vol is increasing, right? So in that case, what would happen is the VIX would not only increase because of a fixed strike slide, right? The fact that the underlying market is lower, but the VIX would also receive an extra boost from the fact that fixed strike vol itself is increasing. So you would see likely a much bigger relative jump in the VIX compared to what we saw on that previous slide. And you would also note clearly that skew, remember we talked about the pivoting and rotating of skew as being giving us a lot of information. So here you can see that the put skew is increasing because this red line is starting to really go a little more hyperbolic or perpendicular, let's say, to the other line. So that's what you would see. Okay, there's a real reason for concern here when you see a chart that might look something like that. And if you were looking at fixed strike volatility in something like this fixed strike vol matrix, then you would see a shade of green, right? Higher implied vol over a given time frame as opposed to large shades of red like we saw in actuality. So if we pull up the fixed strike vol matrix and said, look, market's down 1.5% and vols are sharply up across the board at all these strikes, downside strikes, then that can inform us, or we can take away or infer from that there's a lot of demand for put options. Traders are trying to buy hedges. They're worried about the future. And that can be cause for concern as we start to get into sort of the dynamics of what that means, right? People are buying puts, dealers are short puts, et cetera. That can lead to downside dealer hedging and a sign that volatility writ large may really pick up. So those would be the two things that you want to look for if in the future we have another sell-off and we're trying to estimate, okay, is this just a simple correction, or is there actually something that we need to be worried about? So what is the takeaway here again is that indexified measures of volatility, again, when you look at the VIX index, the skew index, anything like that, they're great tools for quick takes and understanding broad market shifts in sentiment. I look at the VIX every day. I look at the skew index every day because I just want to know, is anything strange happening? If I see something strange is happening, a move up or down, okay, let me drill into that. Look at volatility, underlying volatility, fixed strike volatility to start to break down what may actually be taking place. And I find that that is much more informative when you're trying to place trades around that. And with that, when you're really trying to measure, risk on or risk off sentiment, be it trying to examine if there's right tail risk, right market ripping, or left tail risk, market dropping, whatever it may be, then you really want to look at how the volatility surface itself is shifting. When we say the surface, how is skew moving around, right, across different expirations and things like that. That's all the surface is. And we think that is really well captured by looking at things like fixed strike volatility matrix or skew, term structure, different things like that. So Matt, I now turn that over to you.
All right, great. Thanks, Brent. I know that was a bit of a headier topic. And Brent, there's one more question in the chat if you want to reinforce what I just typed in there about the idea that what Brent's really trying to drive home in this webinar is we're trying to get you in and out in a half hour, do a night one, and make sure that you understand that what we're saying is the VIX can tell you when to look. It can tell you if there's something happening or just happened. But going forward, unless you go one level deeper and see, are people buying puts and driving the market down and creating more downside pressure? Or are they selling calls? Or what's happening to the overall implied volatility? Then you're seeing what could be a head fake. And that's what Brent said, and taking it on the chin, how the market reversed much sharply higher. So what we were coaching our SpotGamma subscribers to learn about as we've unveiled our volatility dashboard is that these tools that we've built over the past year and a half and just recently released will show you when that downside pressure is real, and you can see suddenly a shift of all this buying of puts, and you can see a shift in positioning and dealer positionings changing. So that's really the takeaway from the conversation, as Brent said. And to wrap up here at 8:30 at night Eastern, Brent, if we can go to the second to last slide. Some people raised their hand really quickly. The video will absolutely be available for viewing later. For everybody who signed up, you can go back and watch it again. Thanks for being with us. Brent, can you go to the second to last slide?
Yeah, and Matt, if you want me to just real quick, I know we're coming up against a half hour. I just want to drive it home because it seems like a couple people have the same question. Please. What we saw here on the 31st, right, and into February 1st was the VIX was spiking. And so again, if you were on CNBC, if you went on Twitter, if you just looked at the VIX, you'd say, uh-oh, vol is popping here. This is the fear gauge increasing. We are seeing signs that people are getting concerned about the market, right? I think everyone on this conversation on the call would understand why you would make that statement when you see the VIX jumping higher. However, based on the way that the VIX is calculated, the VIX is naturally going to go up anytime the market goes down. And so what you have to do is you have to look under the hood to see how volatility is actually shifting on a strike by strike basis. And so you can look at skew charts like this or a fixed strike matrix like this, and when you're seeing red, it's telling us that implied volatility is actually going down on a fixed strike basis. When you look at this skew chart, you see, okay, volatility is coming down. It's not shifting up on a fixed strike basis. So when you step away from the mechanics of how the VIX is actually calculated and you look at the underlying data, the two are not telling the same story. And so the critical piece here is, as we wrote in our note, and if you want to take a picture of this, I welcome you taking a snapshot of this. What you actually tell us is that the shade of red informs us that implied volatility is actually going down, even though the VIX is making a lot of noise saying, hey, vol is going up. That was a false signal, so to speak, right? It's not that the VIX is calculating correctly. It's just a function of how it's calculated that it's giving this kind of false signal. So when you see this shade of red, or you see fixed strike vol going down, or you see skew coming down, even though the market is going down, that's telling us that people are not buying puts, that the fear is not real. And so if you got sucked into buying puts or selling off your stock because you saw the VIX pop, then you would obviously have missed a rather substantial rally because of the fact that you went off the VIX or these kind of indexified measures of risk. So I hope that helps to kind of give a better, another clear summary, and hopefully it drives home a couple of that point. And so what is the point here? What would you have done? Well, if you know that this is a false, number here, and you think this is support, maybe you want to buy calls, maybe you want to sell put spreads, maybe you just want to buy stock, right? In these situations, because what's being signaled here is whatever the sell-off is, it's just consolidation. It's not the signal or the start of likely a more larger sell-off, a broader sell-off, and that's really what the and that's how you would take advantage of this in the future when you're watching. So thanks, Matt. Hopefully that second brush with it helped to clear it up a little.
Yeah, I mean, Brent's the expert. I'm kind of the Jiminy Cricket sidekick here. So just to wrap up the conversation, thanks for being with us. Thanks, Brent. Thanks, everybody. Now that you've got an exploratory review of the VIX, I want to extend a special invitation to join us for a comprehensive deep dive into the world of volatility. We're doing this next week, March 5th to 8th. So over 4 intensive days, we're going to walk you through a full review of how to track, assess, and then trade based on volatility. So these questions that we just saw from people in the chat about, well, what do I do to pick the best strike? How do I think about when or where I would want to take advantage of a move downward, or more put selling or put call buying or whatever activity is taking place? We're going to go through all of that, plus then have world-leading speakers from academia and from the hedge fund industry. So Brent, let's do the last slide to give them full detail for those that haven't signed up. We have almost 1,000 registrants already. Specifically, this class includes more than 6 hours of live sessions during the week, full recorded access to all sessions afterward, and at the VIP and platinum levels, there's access to a smaller group setting each day. So these questions about what strikes might you choose, how do you think about those things, it'll be a more intimate setting to answer those in those coaching sections. So now the last time this week to get a seat at the volatility challenge. Just want to really thank you for being with us today. Thanks everybody in our SpotGamma community and those that are new. We try to provide really good and unique insights about how the options market is driving the stock market today. So thanks for being with us. Hope you continue to invest in yourselves with us or anywhere else to really understand how to harness the power of volatility.